against each other in the state of Wisconsin, they really step up to the plate when it comes to how can we save money here, how can we take better care of our clients and make sure that people are as healthy as they can be so they're not using healthcare as often as they were perhaps in the past. So hopefully we still see that kind of creativity happening in the marketplace. But our next speaker, I think everyone here is waiting with bated breath for. Barb is the current president of the Fox Valley CPAs and has been an owner of the firm for 15 years. She has a bachelor's degree from UW Green Bay and her master's of accountantry from UW-Madison. Barb is a licensed CPA and is also certified as a business valuation analyst. She is a member of several accounting organizations, including the AICPA, WICPA, and NACBA. Her firm specializes in small business accounting, tax, and consulting. So please welcome Barb Bader.
Can you hear me? Yeah. Great. I get the fun part. Mine is the good one. They have the bad thing. No, these are the happy things. They're not. I do not like ObamaCare. There. Did I say that well enough? I do not like it. I do not like anything about it. And the thing that bothers me the most about it is the way they are marbling so many different types of taxes. So if you do one thing, well, nobody else is really going to care because you're getting nicked. We'll nick you over here a little bit, but nobody cares about you because that doesn't affect them. So they keep just hitting little pockets of who they're going to hit. And collectively, there's not going to be a lot of people that are going to do anything because if it doesn't affect them, who cares? Somebody else is paying that dollar. And that's the scary part about it. There are so many different taxes that are marbled into it. So what I want to try and do is give you a feel for all of the different types of taxes. I will not go in depth about all of them, but just give you a flavor for some of them. Some of them I will go more in depth because it's going to affect the small business owner and the individual business owner as to their personal taxes and taxes that are related to their employee benefits. So, there's the dollar. First thing, some of these things have been in place already for quite some time, but nobody really knows a lot about it. The first one is there is a small business tax credit for small employers who offer health benefits to their employees. You should have, if you are a small business owner, you should have been taking advantage of this already. If you meet the criteria, not real difficult criteria, you have to have less. Now small employers all of a sudden are less than 25 employees, not 50. So for this particular credit, it's less than 25 employees. If you pay at least 50% of the single premium, or just the employee, and on average your employees earn less than $50,000 each, you should be available to take advantage of this credit. It's a sliding scale. Started off at 35% of the premium. It is going to go up to 50% in 2014. So for all of you employers who have less than 25 employees, you're not going to be subject to the other penalties, and you should be taking advantage of this already. If your CPA did not ask you questions about your health insurance in detail at the end of the year last year, you may not have taken advantage of something you could have. Please ask them about that if they haven't asked you. If you didn't have that sense, why are they asking me all these stupid questions? What do they care? This is why they should care. So if you didn't get asked those questions, you should do it. Ask them the question. 10% tanning tax. That's been there for a couple of years, and the IRS has already audited every Wisconsin tanning salon. They've got a little bug in them to say, we're going to make sure people are following these rules. We're just not going to assume they are. They audited everyone.
Originally, the tax was on voluntary cosmetic plastic surgery, but the the lobbyists that represent went crazy, and so then it went to tanning.
And there's not, again, it's like a sin tax. It's like you shouldn't go tan anyway. You shouldn't get plastic surgery anyway. We can nick you, and no one else is going to care. That was the logic behind that. A couple other ones that they have on here. A black liquor tax on biofuels. I don't know a lot about it because I don't really care about it. It's not going to affect my clients, but I'm sure anybody that sells that is going to care. There's tax on drug companies, and the logic behind this, now they're nicking the health industry in general. They're nicking the people that make equipment, nicking the people that sell drugs. Hey, they want their piece of the action because If we're gonna have 30 or 40 million more people insured, hey, we're gonna have demand, you're gonna need more equipment, and we want our piece of the action. That's exactly what it is, the government, they're playing that role now. I'm gonna give you more money, so I want a piece of it. I'm gonna take 2.3% from this and this one, and we're gonna call it all excise taxes. Nobody ever talks about excise taxes. They don't really know what it means half the time. But excise taxes are marbled throughout all of our industries in e-commerce. 2011, what happened? If you contribute money to an HSA, you get to deduct that from your personal income taxes. And if you pull that money out and use it for something other than medical expenses, you had to pay a 10% penalty. Just like if you pull out from your retirement plans too early, well, they decided on HSAs to have that go from 10 to 20%. No real reason, just they wanted to get a couple billion into this plan, into the government health plan, and to really discourage it more. Another one, if you put flex spending accounts or in HSAs, you could also take money out of there for over-the-counter drugs, and that was okay to do. It was not a problem. That got eliminated. You can no longer take anything out of an HSA, an FSA, or an HRA for non-prescription drugs. All must be prescription. They think they're going to make $5 billion by doing that. They're getting a couple billion here, a couple billion there, and it just adds up. Another thing that became effective, what they call medical loss ratios for small group plans. So for example, I believe, and this technically would probably be a good thing, I believe Network Health did not give any rebates because they spent enough on claims that they didn't have to. I think United Healthcare did give a rebate because the amount that they paid on their claims was less than 80% of the premium. So now the small employers have this problem, okay, how do I refund this little bitty $2 to every employer and every employee that I have? Well, you don't have to, because you have the alternative of saying, no, I'll just use that to reduce future premiums within the plan. I can apply it to future premiums so I don't have to give every employee this tiny little checks back. And it's usually the former employees that call you and ask for the $2. So that was a nice answer. The next one is employer reporting on W-2s, and we've had a lot of questions on this. Now, a small employer is anybody with less than 250 employees for this rule. So for 2012, and I mean the year 2012, we've just started this one for the reporting requirements for 2012. The W-2s you give out now, in 2013, if you have 250 or more employees, you do have to include the total cost of their health insurance. Not what you withheld, but you have to go back and pull your records and figure out what the total premium was for that employee, employer share and employee share, and get it on their W-2. And they're saying that this is to give the employee more information. Highly unlikely. They need to have you start getting information reporting out there so they can track things. So they backed off on making everybody with 50 or more do it, starting in 11, and now anybody with 50 or more, they're backing it off until at least 2014, when these rules really kick in. So if you do have to do it, it's a box 12, code DD on your W-2s. You don't have to do it if you don't have more than 250 employees. For this year, you have to include all the premium, not just your share, not just the employee share. If you want to know more about that, there's an IRS notice 2012-9. And 2013 kicks in, and here's where they really get the money. This is where they're really getting it. FSAs, now they're limited contributions to $2,500. Before that was unlimited. You can still contribute $5 for dependent care coverage. Itemized deductions. Everybody always complained that you had to have more than 7.5% of your income as medical expenses before you got a benefit anyway. I don't understand this, but they increased that to 10%. So now you don't get to take any advantage of your out-of-pocket costs on your individual tax return unless you spend even more than before. But it will give you $15 billion. So that makes sense. The biggest one of all, and the one that people are going to care about the most, is the net investment income tax and the Medicare payroll tax increase. That right there is where the money is all going to come from. And it's going to come from single people making $200 or more a year, and married people making $250 or more per year. And this is going to give about $350 $20 billion for the IRS. It's all Medicare tax, not FICA tax or what we call Social Security tax. And here is the whole plan. Right now, S-Corp owners have what we call pass-through entities. Tax planning will have people try and take a relatively small wage. It must be reasonable, but as small as they can to have it be reasonable. They pay FICA tax on that, they pay Medicare tax on that. Any income above that, they take as what is called an S distribution, an S corporation distribution, which is considered passive income, or return on your investment in your company. It's not earned income, it's just passive. It's something that because you've invested all this money in this business, you have a right to that income also. You don't pay any FICA tax, you don't pay any Medicare tax. It's great. It's a great loophole that people have used for decades. Well, the IRS isn't stupid. They know that there's money on the table, that they can get money from that. So what they're saying is, okay, yeah, it is passive income. All we're going to do is we're going to tax your Medicare tax on it. We're just going to not say it's earned income, but we're going to tax your Medicare tax on it. Normally, Medicare tax for employer and employee combines to be 2.9%. But instead of that, we're going to just charge you 3.8%. Just you pick a number based on the dollars that you need and based on the income that people make. So if you are somebody who makes more than $250,000 a year as a married couple, and you have this passive income coming through, all of a sudden your capital gains, your interest, your dividends, your rental income, your S-Corp flow through, and any other passive income you have above that 250 threshold on your income tax return, you're going to pay 3.8% on it. Okay, so you don't have passive income necessarily, but you have a really beautiful W-2 with a really high number on it, which means you're going to make more than $250 a year. Well, your employer is already taking out FICA, it's taking out all the Medicare tax they're supposed to. But when you do your individual tax return, if you make more than that, $250,000 as a married couple, and you've already had some Medicare tax withheld, they're going to add another 0.9% Medicare tax so that we get to the 3.8, even if it's wage income. So they're going to do it on wage income if you make more than $250. They're going to do it on passive income if you make more than $250. That's more to do with how it's going to get sent in. I am giving you great news, aren't I? So it's irritating to me. You might be able to tell. So 2014, what comes along next? This is when the whole thing really, I think, is truly rolled out. And small employers now small employers have to report on their W-2s, the health insurance premium. And now small employers are 50 or less. Have to report on the W-2s. Anybody, oh no, I'm sorry, small employers all have to report. There's no exceptions except for Indian tribes. I don't care how many employees you have. All employers have to report, starting in 2014. And that means you have to have a way to figure out how much premium you paid, and you have to calculate. Employers with over 50 employees now are going to get hit and pay this shared responsibility, is the terminology they use, if you either don't provide insurance, if you have more than 50, or if the insurance you provide isn't considered affordable and have the minimum coverages that are required. If any of your employees are eligible for a premium tax credit, you're going to get hit with a penalty because it means your insurance is too expensive for them. And if individuals don't buy coverage starting in 2014, they get hit with the $95 per person. Way out in 2018, the Cadillac tax is going to hit in, and that'll hit the health insurer. If they offer something too good, they're going to have to pay a 40% excise tax based on the premium that they charge. And now go forward, here's this basic information again. W-2 reporting, only if you have more than 250 by January 31st this year. And starting in 2014, all employers have to report health insurance premiums on W-2s. It won't be before 2014. And then the next page is about the penalties. A couple other things that I wanted to point out on the penalty part of it. It's going to differ depending on what you offer. If you have a health plan and it's not good enough, you're still going to end up paying a penalty. So first of all, the first thing you have to do is figure out, do you have 50 employees? Because there's going to be a calculation if you have full-time and part-time employees. There's a notice out there that gives a lot of information. It's notice 2012-32. And it walks you through, a full-time employee is somebody who works 30 or more hours a week. Part-time is 15 or more hours a week. And they show you how to calculate, do I have 50 employees? It isn't just that I prepare 50 W-2s for the year. So it's not quite as simple as that. So first of all, you have to decide, do I have 50 employees? If you think you're close or on the line with that, now is the time to start doing some planning as it relates to that, because there's some safe harbors on that as well. When I say safe harbor, I mean something that you can do to protect yourself, even though you might not have all the information you'd like to have right now to be able to do that. So first of all, if you say, I've done an analysis, insurance is too expensive, I'd rather just kill my plan and give it $2,000 a head. That's an option that people can do. But what you really want to do is you want to do that analysis and see what's best for you, what's best for what your employees need, because again, this is a benefit people are looking for. The second thing is your plan affordable? So, and on the 50 count, first of all, if you are close to that, remember this kicks in January 1, 2014, and now is the time we're counting. You're going to look at 13 to decide if you have 50 or not in 2014, you always look for the prior year. So you can't in the year 2014 determine if you have 50, so it's always a year lag. In 2013, you look at your data, and the rule will apply to you in 2014 if that's the case. Well, you don't want on December 31st of 13 be trying to figure out if you have 50 employees for 13. So the IRS has a little safe harbor here, and they're saying, hey, you can use just the first 6 months of the year to decide if you have 50 or not. So that you have 6 months to do planning, and whether or not you want to keep your plan, get rid of your plan, change the amount that you charge employees, change the coverages, to be able to give yourself some time to plan. What is affordable? Affordable is if the premium that you're charging the employee is less than 9.5% of your employee's household income. Now, right there, you would see a problem. How do I know what my employee's household income is? I have no clue. Where do I want to know? And when would the IRS even know that? Okay, you have until October 15th, a year later, to file an individual tax return. So the rules right there seem strange. So naturally, if they have these strange rules, they have something again called safe harbor. If you take your employee's W-2, Box 1 wages, and multiply it times 9.5%, and if you don't charge your employee more than that for the cost of their health coverage, and you have minimum coverages that are required under this new law, then you're safe. And that's why we call it safe harbor. Because otherwise, how would you have any idea if it's more or not than that person can afford? So that's what we call a safe harbor on there, which should be very helpful for anybody right now who's trying to analyze what they should do with their health plan. And the next slide shows you this is what the penalties are. If you say, forget it, I'm getting rid of my health plan, this is nuts, I don't want to have to deal with it and all the reporting, $2,000 a head for every employee above 30. Right, you come, it's for all employees when they take off 30. You get to take 30 off after the first 30. $2,000 a head. Or if you have unaffordable coverage, again, the 9.5% rule, then just for those that it's unaffordable for that and get money through the exchange as a subsidy, is $3,000 per person there, but they won't charge you more than $2,000 a head as a maximum penalty. And what I find most onerous about the second part is a monthly calculation you have to do. Monthly, not an annual calc. You have to go in and monthly do it. And then the most odd thing about this reporting is that none of this gets reported on corporate income tax returns. Now we have another separate reporting structure where I'm sure based on if you send in more than 50 W-2s, you're going to get a notice from the IRS. The IRS is going to send you a notice and say, do you owe us a penalty? And then you're going to send them something back, and I'm sure forms will be developed for all of this. You're going to send them something back, and you're going to say, yeah, I do. I owe you this much money. Then they're going to send you an assessment. I have never seen anything done in this fashion before, but you don't have to do it until the extended due date of your corporate returns and the extended due date of your employees' individual returns. The most strange thing I can possibly imagine, and I'm sure that as procedures are changed in the next couple of years. Some of this probably will change. It just sounds too odd to be true, but the way this whole bill came to be, it kind of makes sense that there's some oddities about it at this point in time. The next one. This, if you want, just send an email to my email address, barb@fucpa.com. It's got a great calculation here that you can use this to help you decide what is the after-tax cost of providing health insurance versus paying the penalty per person. And you can use your own business's data to decide, does this make sense or not? Should we continue to provide health insurance? Would it make more sense to not provide health insurance? And it does give you an economic basis for that decision, but there's a lot of calculations that need to go into it. But it's a nice little template to do.
And again, that's for employers with more than 50.
This is for employers with more than 50 employees. Because at this time, starting 14, that's all it's going to affect. My hunch would be that won't last very long, and I would guess that down the road it's going to be all employers.
And just so it's clear, 50 employees doesn't mean you count 50 heads.
Correct.
It's a full-time employee equivalent. So there's a calculation for all of your employees and the hours they work to determine if you have 50 or not. So potentially you could have 30 employees and have 50 full-time equivalents.
Is that an average over 4 quarters or?
Monthly calculation. I think that's the worst part about this is for these small employers. The onerous side of reporting, I think, is what's going to make people just pay the $2,000. Which again, there's that little cut somebody's getting.
Yeah.
That's what's sad about it. It's like they're providing a real incentive for us to want to throw money at them for free.
So they start on January 1st to determine that month if they have to.
And then there's special rules if you have a fiscal plan for your health policy. It gets more complex depending on that.
So it's not going to be related to their state income tax or employers or anything like that?
No, nothing that simple.
Nothing that's simple.
Nothing that simple.
Nothing that logical.
Nothing that logical. That's right. That's right. So if anybody wants us to send me an email, then I believe that that's about it. Thank you very much, and I hope this is informative for you.